The TLT ETF, or iShares 20-plus year Treasury Bond ETF, is an exchange-traded fund that tracks the performance of U.S. Treasury bonds with maturities of 20 years or more. It's a popular choice for investors looking to gain exposure to long-term U.S. government debt, and it's often used as a tool for portfolio diversification or a hedge against economic uncertainty. Here's how it works. When you buy the TLT ETF, you're essentially investing in a basket of long-term U.S. Treasury bonds. These are considered some of the safest investments because they're backed by the U.S. government. TLT provides investors with exposure to the price movements and yields of these bonds, making it a simple way to access the bond market without buying individual bonds directly. The price of TLT moves inversely to interest rates. When interest rates go down, bond prices go up, and so does the price of TLT. Conversely, when interest rates rise, bond prices fall, and TLT's price drops. This is because existing bonds with lower yields become less attractive compared to new bonds with higher yields. For example, if you hold TLT and interest rates fall significantly, the value of your investment could rise as the price of the bonds in the ETF increases. Let's break it down with an example. Suppose the Federal Reserve announces a rate cut to stimulate the economy. This lowers interest rates across the board, making long-term bonds more valuable. If you own shares of TLT, the ETF's price would likely rise as the bonds it holds become more attractive to investors. However, if rates rise due to inflation concerns or Fed policy changes, TLT's price would likely fall. TLT is often used by investors as a safe haven during times of market uncertainty. When stocks are volatile or the economy is shaky, investors tend to move their money into U.S. Treasury bonds, driving up the value of TLT. It's also a common choice for hedging against deflation or slowing economic growth, as bond prices usually perform well in these scenarios. However, there are risks to investing in TLT. The ETF is highly sensitive to changes in interest rates because it focuses on long-term bonds, which are more volatile than shorter-term bonds. A small increase in interest rates can lead to significant price drops in TLT. Additionally, while TLT provides safety from credit risk, since U.S. Treasury bonds are considered very secure, it doesn't protect against inflation risk. If inflation rises, the fixed interest payments from Treasury bonds lose purchasing power, and investors may see diminished returns. Another consideration is yield versus price movement. The yield on TLT is relatively low compared to riskier assets like stocks or corporate bonds. If you're investing for income, TLT may not be the best choice because the yield reflects the lower risk of U.S. government bonds. However, its price movements can offer substantial gains during periods of falling interest rates or market uncertainty. In summary, the TLT ETF is a simple way to invest in long-term U.S. Treasury bonds, offering safety and diversification. Its price moves inversely to interest rates, making it a valuable tool during economic downturns or falling rate environments. However, it's sensitive to interest rate changes and inflation risks, so it's best suited for investors who understand its behavior and use it strategically within a broader portfolio.